Depreciation, depletion and amortization, that is DD&A, is an accounting technique that enables companies to gradually expense various different resources of economic value over time in order to match the costs with the revenues. I am Dr. Sonal Chanda, Professor, Department of Commerce, Srimati Keshavai Lahuti Mahavidyalaya, Amravati. In this presentation, I am going to discuss with you on one of the very important chapters, that is depreciation, depletion and amortization, how they are same and how they are different from each other along with their illustrations. What do we mean by depreciation, depletion and amortization? Depreciation spreads out the cost of a tangible asset over its useful life, whereas depletion allocates the cost of extracting natural resources such as timber, minerals, oil, etc. from the earth. And amortization is the deduction of intangible assets over a specified time period, typically the life of asset. Friends, depreciation and amortization are common to almost every industry, while depletion is usually used only in the companies where the companies are associated with energy or natural resources. The use of all these three, therefore, is often associated with the acquisition, exploration, and development of new oil, natural gas reserves, etc. Friends, let's know a little more about depreciation, depletion, and amortization. Accrual accounting permits the companies to recognize capital expenses in periods that reflect the use of related capital asset. In other words, it lets the firm match the expenses to the revenues that help produce. For example, if a large piece of machinery or property requires a large cash outlay, it can be expensed over its useful life rather than in the individual period during which that particular cash outlay has occurred. This accounting technique is designed to provide a more accurate depiction of the profitability of the business. Friends, DDA is a common operating expense. So far as the mines or the energy companies are concerned, analysts and investors in the energy sector should be aware of the expense and how it relates to the cash flow and capital expenditure. Well, depreciation and amortization, these two terms are associated with almost all the companies because goodwill is one of the intangible assets which is amortized. So, naturally, every company has to think on depreciation and amortization both. Friends, depreciation applies to expenses incurred for the purchase of an asset with the useful lives greater than 1 year. A percentage of the purchase price is deducted over the course of asset's useful life. Depletion also lowers the cost value of the asset incrementally through the scheduled charges to income. Where it differs is that it refers to the gradual exhaustion of the natural resources reserves as opposed to wearing out of a depreciable asset or the aging life of the intangibles. Depletion expense is commonly used by the miners, loggers, oil and gas drillers, and the companies engaged in the natural resource extraction. Enterprises with an economic interest in mineral property or standing timber may recognize depletion expenses against those assets as they are used. Depletion can be calculated on the basis of cost or percentage basis as well. and businesses generally must use whichever provides the larger deduction for tax purposes. Amortization. Amortization is a very similar to depreciation in theory, but applies to the intangible assets such as patents, trademarks, licenses, rather than the physical property and equipment. Capital leases are also amortized. Friends, keep this in mind. Very important point. After having an understanding about what is depreciation, depletion, and amortization, let us know how it is recorded in the financial statements. If a company uses three of the above expensing methods, they'll be recorded in the financial statements as DD&A, that is depreciation, depletion, and amortization. A single line providing the rupee amount of charges for the accounting period appears on the income statement. If at all there is no depletion under those circumstances, depreciation is provided along with the amortization as well is provided on the income statement, that is debit side. Explanation may also be supplied in the footnotes, particularly if there is a large swing in the depreciation, depletion, and amortization charge from one period to the next. An entry is made on the balance sheet too. The rupee amount represents the cumulative total amount of depreciation, depletion, and amortization from the time the assets were acquired. Assets deteriorate in value over time, and this is reflected on the balance sheet. So friends, let us conclude. Depreciation is associated with the tangible assets. Amortization is associated with the intangible assets. And depletion is associated with the natural resources. I'm sure this is more than enough to make you understand the basic difference between these three terms. Friends, this is shown not only on the debit side of the profit and loss account or income statement, but also it is used to show the book value of the respective assets. Thank you so much.